learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, today we'll discuss about the dilemma that many investors face. Investing in equity, but how to invest, how to go about it. Invest in stocks directly or go the mutual fund way. And to help us decide, we're joined by our CEO, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Dhirendra, over the past year, especially when the market, it has been on a high, a lot of investors have started investing in equity, more so directly in stocks. A lot of demat accounts were opened recently. And so what is happening? Why are people, suddenly ready to take the plunge and not go the safe way? Mutual funds are safer, but not.
No, the lure of investing in stock is very compelling. People get attracted. Variety of reasons. Let me just get to the context that what is going on. One is that interest rates have come down to a very low level. India has a very large population of very young people, and market has been steadily going up. And in fact, market has continued going up despite all the negatives building up in terms of apprehension about the economy, but still the market has gone up. Companies' earnings did not collapse. That is why the market has continued going up. So it's understandable that if market sustains its level, if markets keep rising, then investors will get attracted. Now investors are getting attracted to all dimensions, all kind of market exposure. They are investing in IPOs. They are investing in mutual funds. Even mutual funds are seeing record number of new investors coming in. The amount of money coming by way of SIP is also rising month after month. In mutual fund investors of past, old investors, they have experienced their wealth, the wealth effect. Their money has gone up and they are feeling happy about it. So if they can save more, they are investing more. And they are investing in stocks. Then they are investing in many other ways of investing in stocks, which is IPOs. Then there is a very popular, at Value Research Online, we are getting plenty of questions that there is a company called Small Case, and it is offering a package of a bundle of stock based on some theme or style or some predefined strategy, some strategy or style, and a lot of people are getting attracted to it. Over and above this, then you have PMS. If you have 50 lakh rupees, then there are portfolio management scheme offered by portfolio managers who are regulated. They also offer you, exclusive access to their fund management. So, and a lot of investors think that it is high value, customized portfolio to your needs, so it might be a great thing, and it could be useful for some. These are vehicles which has helped investor participate better. On top of it, you have this zero brokerage broker, the Zerodha one, which has came from nowhere and has become the largest stock broker in the country. Then you have many others like them. The Grow app, where people are able to, in 5 minutes time, they are able to get started. So access to the market has become seamless. If you choose to invest in the market, and if it is a marketer, and if you have an Aadhaar card and an online bank account, then you could be an investor in 15 minutes flat. It is that simple. Now you invest through a PMS, or you invest through a small cap, or you invest in a mutual fund, or you invest in an index fund, or whatever you want to. All of it has become easy, and investors are investing in all of them. Now, the particular question that a lot of investors ask at Value Research is that should they be investing in small case? Let me just list the positives and the negatives. Positive is that it might save you some money. It is low cost because all you will incur, you will not even incur brokerage, so only the limited cost, and then there will be a fee of small case subscribing to that. That which will be a fixed fee, which will not be a fee which is linked to assets under management. When you invest a lakh of rupees, or if you invest 1 crore of rupees, if the expense ratio of a fund is 0.5%, then that 0.5% is charged on the amount of money that you invest, including the rise. So, if your 1 crore rupee becomes 1.5 crore, then you'll be incurring cost on 0.5% on 1.5 crore. So in that sense, it is a recurring rising income if your fund does well. That is what happens in a mutual fund. That is what happens even in a PMS, where you entrust your money to somebody and he is managing it. When you invest in a small case, you are basically paying for the advice, which is embedded in the list of stocks in a certain proportion. And you can click, and with a single button it happens, and you are not liable to pay taxes till you sell it. But my apprehension is that, how closely you will monitor it. Then I don't know what kind of effort or energy has gone into monitoring those stocks, or how much effort will go in monitoring those stocks. Then, there could be tax implication when you invest in a small cap and a small case. And if that strategy requires regular intervention, if it is not generally a buy and hold strategy, then it is wonderful. You will invest in a stock and it has to be held for many, many years. You are not liable for paying taxes. But the moment you have a strategy which requires constant monitoring and selling, then your capital gets reduced. Ever since we have long-term and short-term capital gains tax on equity investment, short-term capital gains tax is 15%. Long-term gains tax is 10%. So if you invest 100 rupee in a fund, in a small case, in a stock, and it goes up to 150 rupee, and if it has happened before, and if there is a need to sell before 1 year, then the gain of 50 rupee, it will be reduced by, you have to pay 15% by way of capital gains tax, and your money will get reduced to 142 rupee 50 paisa. If it is after 1 year, then it will get reduced to 145 rupees. Then you invest 145 rupees. So this deduction, this inability to compound comprehensively is a barrier, is a disadvantage. What happens in case of mutual fund? You invest 100 rupees. Whatever the fund manager does, it doesn't matter. You will be liable for taxes only when you pull out. Yeah. And when you pull out, you will be liable for taxes at the end, not in between. So here in between, your money capital will keep getting reduced. Now there is, that is a disadvantage, and the advantage is, of course, low cost. But it may not be low for very small investor, because if the cost of subscribing to that small case strategy is 5,000 or 10,000 rupee, and if you are investing 5,000 rupee only or 10,000 rupee only, then you should look at it that what is that money, what is the fee as a percentage of the money that you will be investing. If you are a 5,000, 10,000 rupee investor, you will be much better off investing in a mutual fund, because the amount of expense that is levied on that your 5,000, 10,000 rupee will be nominal as compared to the advisory fee which will be levied on the small case. So it depends. I would say all of it is fine. One should be investing one's long-term money, the money that you are unlikely to need for a couple of years, invest in equity. Few weeks back, I was talking about, equity fund, actively managed equity fund versus passive, index fund. Invest in an index fund. Invest in an actively managed equity fund. Invest in a small case. Invest in a PMS, whatever you want, or invest in stocks directly. If you have the time and inclination, you can also save the fee of small case, and you can invest in a bunch of stocks yourself.
As long as it is equity.
As long as it is equity, and as long as you are, investing regularly, going to stay for the long term, it doesn't matter. Be there somehow, be there for the long term, and that is the only way for you. That's the only promise most investors have to beat inflation, because the kind of inflation that we are going to see, or we have witnessed in the past, fixed income is not going to beat that. Your money will keep getting reduced month after month or every day because of the high inflation and lower rates. So you have no choice, because equity is the only promise where the goods and services and the earnings of those companies will get aligned with rising prices. So invest in equity, whatever be the form.
But if one has to choose between investing in stocks and investing in mutual funds, like so then how should one go about it? What should be the deciding parameters, stock or mutual fund?
I would say that, investing in stock requires a couple of things, which one investor must have. Otherwise, you should not fiddle in that. Because market is a very dangerous place if you don't understand how to conduct yourself. And conducting yourself means, in fact, it is doing very few things, which is choosing a good company. Choosing a good company and that being a good stock is also a different story. There could be a great company, but it may be a lousy stock. So choosing a good company and building a diversified portfolio, and that diversification could be, of a certain kind. It could be 5 stocks, it could be 10 stocks, it could be 15 stocks. Then investing in stocks directly requires time and inclination, besides temperament, because market is going to remain the way it is. It will make you crazy. It will go up when you least expect it, and it will go down dramatically when you least expect it. When you are very confident that now the market will only go up, that is the time when it will go down dramatically. And when you think that it is very dangerous to invest in market, that is when it's a great time to invest. So it is very hard for an individual investor to be investing in stocks. So if you don't have that temperament, and that temperament will come only if you have some experience, you know how the market conducts. If you are a contrarian, you're courageous. Not only that, you should also have the long term money. If you are investing for the long run, but you need the money day after tomorrow, you understand this. So it won't work. Your temperament will not actually be favorable. You will be very scared at the slightest fall. So if you have time, if you have inclination, and you have this temperament, besides that, then it requires understanding. Because many people think that stock market is in a rising market. A lot of people are coming, and there is nothing new. It has happened in the past. In the last 30 years, ever since I have been running value research, every rising market attracts investors in same quantity, in same numbers, in different forms, but somewhat similar. It happened in early 90s, 92, 93. Of course, at that time it was Harshad Mehta's scam. The market went up from 1,000 points, below 1,000 points to 4,000 points in 2 years flat. And that was also the time when mutual funds were also attracted money. The Master Gain, India's largest mutual fund, was launched then. In fact, the scale of that fund was such that it will be bigger than any mutual fund launched ever since, if we adjust it for the Sensex value. Then the early 2000 technology funds were booming. Then 2008 the infrastructure funds boomed. Then recently 2-3 years, everybody thought that the market will go under for a long time, and market has only steadily kept going up. So there is nothing new. Investors will get attracted when money is being made in the market. The real thing is that when the tide turns, how many people will run away forever? How many people will actually not run away? How many people really understand that okay, that is a definite part of the game. It is an inherent part of your investing. So that is what scares me, and that is why you need a plan. That is why. So if you have, and that requires some understanding. When that stage comes, as I was explaining, that it requires understanding. If you understand what a company is, this company will withstand the decline. It has something to do with market, not with the company, because markets can go crazy. Businesses don't. Some businesses do go out of favor. Some businesses die. Some businesses come up. They are born and they thrive. So we don't know the companies which are born and that they seem to be that okay, they will thrive at some point. The new IPOs, whether we talk of Nykaa or Paytm or things, it is a hope that at some point these companies will thrive. Right now they are not making company, and that is why there's optimism about these companies. But if they don't, it will be disappointing. When it will be disappointing, investors will run away. Investors will suddenly have this realization that all the story was not true. And these realizations happen in a very, about market, the story is why it scares people, why it is very unnerving for people, because markets go up steadily, even in a good market, that the way we have seen it in the last 2-3 years. So they climb a staircase and they come by the lift, by the elevator. And that is what scares, because the dramatic fall, we saw it last week, that market went down by 5% in a day. That is very scary. It rarely goes up by 5% in a day. Once in a while it does, but very occasionally. So that is quite scary. And that has the potential to drive. Besides that, there are many investors who participate in the market in the futures and options. They are doing some kind of leverage trade. They are putting 100 rupee and they are taking a position in a 1,000 rupee stock. And when the 1,000 rupee stock on an investment of 100 rupee goes down by 10% to 900 rupee, his capital gets wiped out. So he has lost 100%. But the reverse of that is true. If one is able to participate in the rise of 1,000 rupee with a 100 rupee investment, then the it is an outsized return because it is a leverage trade. You are able to leverage it substantially. So stock market, if you are actually a leverage trader, then it will exaggerate. It will actually magnify your returns, and it will also kill you one day. So one has to be very careful about that, and that is what makes stock market a speculator's den. That is what is very scary. But it is actually great fun till it doesn't hurt you. Till that, it looks like the easiest way to be wealthy. So be aware of all this. Invest in a stock if you have time, understanding, can read a balance sheet, know that you have the temperament. If not, start your SIP, invest in a diversified fund, and carry on with that. Uh, if you want to try out any of those things, do try. Invest, your 5,000, 10,000, 50,000 rupees in small case. See if it suits you. But they still have to prove themselves. I would say that while before investing, one has to see that what is the track record, how it has done, and all the small cases. And now you have to choose carefully. You have to choose a small case or any such, predefined strategy, which requires least intervention. It should be low maintenance, because if you're comparing it against mutual fund is absolutely low maintenance, because once you invest in a mutual fund, the fund manager is responsible for making the changes. That doesn't mean that the fund doesn't change. In case of a small case, you have to make those changes, and it will have tax implication. So just be careful. Choose a strategy which requires less intervention. Choose a strategy which has some credential. Don't buy into an exotic idea which has not been proven for a while. It is always good. And individual investors getting started, they should not invest in any of those. Start with a balanced fund or with a diversified equity fund. Carry on for a while, because you have to experience and learn about markets and market behavior, and you have to develop an ability to stick around. And anything will help. Even a balanced advantage fund will be scary, but it will be least scary. Followed by a balanced fund, followed by a passive fund, followed by an actively managed fund. And likewise, the volatility keeps going up. But volatility may not be risk. Things can be volatile, but it can actually go steadily up over a period of time. So it takes time to appreciate it, and take your next step. Get going anyway.
So you're saying start with mutual funds, and then once you have that kind of experience, then you can
Yes,
probably
it requires, requires being experienced and getting used to the mutual fund the market's madness.
Time now to move on to viewers' questions. The first one has been sent in by Kanu Agarwal. Kanu asks, what are the most critical factors one should consider while picking a stock?
Picking a stock, I think, 3-4 things. One is that it should be a business which is growing, and rapidly growing business. A business which is making money, so reasonable margins, and run by a great set of people. Because when you are buying the stock of a company, you are actually becoming partner with a set of people who are either your partners, or they have entrusted it to the right people to run that business. The promoters may not be running the business, but they have chosen good people, but they will have undue influence over the set of people who are managing it. And it is managed by a good set of people. Otherwise, you run the risk of investing in a business where some people might be stealing money and you may not be aware of it, and that will not translate into growing earnings and growing profits, rising sales, rising profit, and which is growing over time and managed by a good. So these are three broad things which I look at. And then the fourth important thing which one should keep in mind is, you are buying something at a reasonable price. If you are buying a great company, a company which is growing, company which is making profit, a decent margin, and at the same time, it is managed by a good set of people. A good set of people actually, translating into all this. And of course, growing means, it should be a scalable business. If you're doing a business which has a ceiling in terms of it can't go beyond this. So keep those things in mind. And after that, buying it at a reasonable price. Because if you buy a fancy stock at a fancy price, you will never make money, because you have already paid the price which is reflective of many years of future earnings. So these four things.
All right, then 80-year-old Vivekananda Roy is a small retail investor who's been investing in small batches of stocks and has around 24 stocks in his portfolio. These stocks have got him a compound annual growth rate of little more than 20%. So, should he continue with them, or would you suggest any other avenue for the long term?
No, I think, if he's following, if he understands, 20% CAGR over what time period depends. If it is over the last 1 or 2 years, it is not good. If it is over the last 5-10 years, it is impressive. If it is over the last 15 years, it is great, because with all the ups and downs, if you have earned 20% looks like a very modest return, because, last 1 year, many of the funds have given 45% return. But what we miss out is that the year before that, they lost 20%. So one has to look at the longer the period. 20%, if it has been achieved over the last 10 years, it is a great return. I don't think then you need my advice. You are on to a great track. Keep up the good work and keep sharing your, how you have done it. I'll be very interested in knowing how you have achieved this.
All right, now Naveen says, we saw a correction in stock market recently. Do you think a bigger crash is on its way? And if so, how should we protect our gains and equity investment?
One is that we saw a correction, and that everybody saw. The market did go down dramatically in a brief period of time, and then after that it has also recovered quite a bit, or recovering steadily. Do I think a bigger crash on its way? No, not really. I can promise you one more thing, that in the short period of time, nobody knows anything. Because if somebody knew about it, one can have a broad hunch. One can have a broad sense that, okay, market looks very one might be very uncomfortable with the market. Market may have gone up very dramatically, so a lot of people will be scared of being there. A lot of companies might be looking at a price which might look very rich, very rich valuation, because and there are some such situations. But I don't think, despite that, market goes up, things look expensive, and market continues going up. So it's very difficult to predict that in the short run. In the long run, you have to see that over the next 3 years, 5 years, do the company's earnings will go up even higher. Is there is there a very compelling or pointer to a great speed breaker there? No. So I'm very confident about the potential of the market over this time period. But during this period, will there be companies which will actually go under? Yes. Will a lot of people?
But they'll always be there. Some
will always be there. No, more so now, because many people will be buying those IPOs, which with hindsight, a period from now, 1 year from now, 2 years from now, will look stupid. That why somebody paid so much price for this IPO when it was not making money. But not right now, because still people are still deriving the comfort because the price has gone up, so they think that it is all right. I made my money. It doesn't matter whether a company makes money or not. So once the reality haunts you, once you have more realistic assessment of situation depending on the fundamentals, it's a different story. But for now, and that is why nobody knows. In fact, the riskiest bet might have proved to be more rewarding. And a reasonable bet, less risky bet, might not be as high performance so far. So I would say that it is a bigger correction or a steady rise from market or a dramatic rise from market. Nobody can predict that. So don't ask me that, and don't expect an answer from me ever. How should we protect our gains and equity investment? Yes, there is a way to actually protect your gains in equity market. Rebalancing. You should choose, if you're a long-term investor, you should still have some allocation to fixed income. Whether that be 25%, whether that be 50% is your choice. Then because the market has gone up, so your equity will, if you have chosen 50-50, then your 50 will actually become 60. And the 40 in fixed income has not gone down, but because the equity has gone up, it will become 60. You take a part of 60 of equity and realign it to 50-50. So you have booked some profit from the rising assets. Likewise, if the market comes down, your 50 in fixed income will become 55. That is also the time when equity has gone down, so you can take money out from fixed income and move into equity. So that is the way you should do it, in a marginal way. You should not do it in a knee-jerk way. never attempt that you should be 100% into equity or 0% into equity, because that is a very dangerous thing. Dangerous thing on two fronts. One is that most of the market moves happen when you least expect it. So when you are out of it, when you are very scared, the big move will happen in a period of 1 or 2 days, 5%, 10%, 15%. The big move has happened, and then you will actually jump into it. Then the other problem is that if you try and time it like this, if you are substantially in and out of it, you will be too scared to get in when the market is most attractive. So it'll hurt you on both front. You will be out of the market when the market will make its big, will go up by will leap forward, and you'll be too scared to get into the market when it is the best time to invest, when it will all look very scary, and that is why you'll be scared. So don't attempt this.
Now, today's last question has been sent in by Sunil Kumar. He asks, how are rolling returns calculated and how important are they while choosing a fund? Which fund should one choose among an emerging blue chip, flexi cap, and a contra fund for a 10-year horizon?
Very difficult questions to explain, but okay, I'll explain, the return framework. One is that first you should understand the kind of return that we see in fund fact sheet as well as at value research. When we look at 1-year return, 3-year return, 5-year return, it is the return 5 years ago, the NAV 5 years ago, and today's return. The difference in the NAV and in relation to the starting point, which is the start, and what it translates into. This is the percentage change from that NAV and annualized during the period. Apply the compound interest formula and from 100 to 500 to understand what the CAGR is. But this is only an academic exercise. This assumes that 1-year return means you are invested in a fund exactly 1 year ago and today you are selling it. While the rolling return is that if you are looking at the 1-year return, you calculate 1-year return over a long period of time and then you average that return. And that average of that return, and the advantage of this rolling return is a reflection that this is the likelihood that you would have got this return. While the trailing return is exactly it might be a chance that trailing return could be misleading. There's a possibility, assuming that what happened in March 2020. If somebody calculates the return of a fund from March 2020 to March 2021, it will look like 100% return.
Yeah.
But what it does not capture is that before that low, the market came down by 40%. Yeah. And in a very brief period of time, or 30%, 35%. So your 100 rupee became 65 rupee and 65 rupee became 130. So it might look like 100%, but it is actually not holding it. It is not really capturing the big decline that happened in between. Whereas if you calculate the rolling return, you will calculate the 1-year return every day. So you will get those 100%, you will get those 50%, you will get that 45%, you will average it, and that will be so it is a better reflection. It is a more credible reflection of the likelihood of achieving that 1-year return or 5-year return. So while choosing a fund, look at rolling return. Where do you get it? It's a difficult thing to calculate. It's a cumbersome thing to calculate. On Value Research Online, when you go to the performance page of any fund, you can look at the rolling return of every fund. It is there in the graphical representation. The first one is the trailing return, the first graph. The second one is this rolling return. You can look at the rolling return of each and every fund over different time period, 1 year, 3 year, 5 year, 10 year. Yes, there is one constraint of rolling return. The constraint is that you need a longer period. If you have to calculate 1-year rolling return, the fund must have a 2-year history. Otherwise, how will you calculate different 1-year return? You need many readings of 1-year return. So to calculate 5 years rolling return, you need a fund which has a longer history than few years more than 5 years.
Okay, and he's also asked which fund should one choose among an emerging blue chip, flexi cap, and a contra fund for a 10-year horizon?
I don't have a straight answer to this question because there isn't a straight route to there isn't a rule which governs this. A flexi cap fund invests where the fund manager has the discretion to invest in large cap, mid cap, small cap, wherever he wants to. and it is a nice vehicle. It's a good diversity. This is the truly diversified vehicle which will help you. And most of them are growth funds. So they follow the growth strategy. So this is one. But the reality is that many of these funds are getting constrained because they normally have allocation to small cap fund only till they are small. But once these funds become very big, they don't invest in small cap because they are constrained to invest in small cap. So, and this emerging blue chip fund, this is normally referred to the mid cap funds. Mid cap funds are named as emerging blue chips, because blue chips are generally large caps, and these are the emerging ones, or they're showing promise. That's the rationale for the name. And mid cap funds hold great promise. They're fast growth companies which are well on their way to become large cap, and that if they become one, they will be hugely rewarding. But it is meant for, they also tend to be more volatile. They also fall more when the market falls. And likewise, the small cap, which he hasn't mentioned, but small caps, if you look at the last 10-year, 15-year return, the small cap funds have delivered the highest return. But it does not reflect, it does show the real, downside, which when the market goes down, whenever the market went down in the last 10 years, some of these small caps went down in value by 70%. Will you be okay with that? When you're 100 rupee, when you have seen the value of your money going up to 100 rupee, and it gets reduced to 30 rupee in a brief period of time, and then sticking around with a small cap gets risky, gets dangerous. Contra funds is also a good option, but it's very hard to find one. Contra fund, the fund manager is mandated to choose a stock which actually shows a contrarian thinking. The market doesn't like those stocks, but he thinks that these stocks are worth buying, and so up to this point it's fine, but he has to be right, because if he goes wrong, then he goes wrong big time. So I think there is no straight answer to this. If you can really withstand, I would say that start with a 10-year time period. Start with a flexi cap fund. After 2-3 years, once, because they will also be volatile, but not as volatile as a blue chip fund. They will not as be risky as a contra fund if they don't do well. And after that, maybe allocate higher money to small cap and mid cap, 20-30% money to from your flexi cap fund to mid cap and small cap, but only after you're convinced about yourselves that after a fall you will not run away.
Okay. Well, with that, it's a wrap on this episode. Thank you, Dhirendra. Thank you to all our viewers. Do keep watching this space for more information. Keep sending us your questions. And if you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.